Good morning, everybody, and thank you for joining us for the Survey and Spatial webinar today. Our presenter is Tony Alexander, who a lot of you will know is an independent economist based here in New Zealand. So if you have any questions at all that you'd like to ask Tony at the end of this presentation, please pop them into the Slido box and I'll read them out to Tony at the end of the webinar and he will answer those for you. So you're up now, Tony.
All right. Thank you very much for that, Jenny. And yeah, don't get too optimistic in terms of the answers coming forward. I find myself with increasing frequency writing articles regarding the low predictability of a lot of what is happening around us at the moment. I've just written one this morning about interest rates. People are talking about, well, how can the Reserve Bank still project to keep the official cash rate above 5.5% in late 2024 when they project inflation by then will be about 2.5%. So I'm having a look at previous times in the past when we've had that sort of divergence in there and then just end up scratching my head going, yeah, but I'm not sure if that applies in the future or not. So point number one, I just wanted to get across, and in most of my other talks I've been doing this year, I'll actually spend 10 to 15 minutes on this one. There are many uncertain variables in play for the New Zealand and world economies. Do not strongly base your operating plan, your cash flow projections, etc., on the assumption that a particular scenario is going to prove correct. We're going to continue to get a lot of, I guess, volatility out there, and the big thing in play at the moment, obviously, is with regard to interest rates. Now, I'm here to give a bit of an update on the economy and have a look at what the potential impact of the two coalition agreements signed between National and New Zealand First and ACT, respectively, may have on the New Zealand economy going forward. Now, this is actually a relatively difficult task to do, partly because there are so many individual points which have been included in a number of documents in terms of what they plan to do, what they have agreed to do, what they would like to do, what they have agreed to progress or make some sort of advancement on during the 3-year period. I think with greater certainty, we can obviously have a look at the coalition agreements themselves, and a lot of what they were about or are about is rolling out or making adjustments to what National had already proposed in one of their other documents there. There's about 4 or 5 of them that you can go and have a look at. Now, the overarching point I guess I'd like to get across is that clearly we are looking at a government of change right from the start, making that explicit. We've had that, for instance, over the past 6 years with Labour-dominated government, but fairly much surreptitiously behind the scenes, making some relatively large changes out there. This time, it's right at the front there. Maybe it's more akin, quite frankly, to either going back to 1987, when Labour were re-elected explicitly to finish the job of reforming the economy, or maybe even 1992 when National came in back then, for instance. So we are certainly looking at some changes, but are we actually looking at much of an alteration in the likely track for New Zealand's economy over the next 3 years? Now, it would be great to say yes, that with the sort of top of the list emphasis which ACT, New Zealand First and National have put on improving the state of the economy, boosting productivity, that's right up there as a number one thing. But that's very unlikely that the policy proposals they have listed down there, many of them, that they're really going to lead to any great changes in the likely rate of growth in our economy, productivity in the short term, even medium term. What they're looking at, their changes, will, I think, have definite positive long-term implications for growth in our economy, the rate of growth, the rate of productivity growth in particular. But overall, I've yet to see anybody saying that the outlook for interest rates, for instance, is different from what it was 3 months ago as a result of the change in government. Having said that, I think the outlook for interest rates is slightly better because overriding everything I'm about to say now is one clear thing when we look at macroeconomic policy. We've got monetary policy, which is tight. It's going to stay tight for a while. The aim of tight monetary policy is to slow down the rate of growth in the economy, and get inflation down. And often, when you have monetary policy tightened by a central bank, they will use words along the lines of monetary policy needs friends. They're basically sending a signal to the government that interest rates won't have to be as high as would otherwise be the case if fiscal policy were also to be tightened. And that, I'd suggest, is the overriding thing we can expect here from the government, that fiscal policy will be tightened, that although we have tax cuts coming in from the middle of next year, we're looking at spending cutbacks, and we're looking at the attempt by the government to return the books to surplus in 2026-27. We'll get an update on December 20 as to whether that is a realistic prospect or not. But overall, when you look at the actions of the government, in fact, we're talking about a slightly depressing impact on economic activity because of a likely tightening of fiscal policy, probably most strongly hitting into Wellington, where we have seen quite that blowout in the numbers of public servants over the past 6 years, extra money, etc., being spent on consultants. We'll be looking at quite a decline there. I've seen one or two articles saying, oh, well, this is going to, depress the Wellington housing market. It's a factor there, but I think there might be some bigger factors in play, quite frankly. But point number one, I'd like to get across, there is a tightening of fiscal policy coming up, and that will apply some extra downward pressure on the pace of growth in the New Zealand economy. Related to that, let me just note, from early this year, I've been saying whoever would win the election, there was going to be a tightening of fiscal policy anyway, because of a deterioration in tax receipts being reported each month by Treasury from about March this year. We were going to see some sort of a tightening anyway. Hence, no necessarily great change in the outlook for interest rates as a result of what we're talking about there. In terms of the economy overall, we're looking at restraint on New Zealand's economy. No one should be expecting that we're going to see the growth rate accelerating to any great degree until maybe 2025. We have weak growth in our main trading partner of China. They've got some big issues I won't go into here over there, and that's going to keep export prices relatively restrained, and also the just the overall demand for our products relatively low there. There is still the tight monetary policy. The inflation rate of 5.6% is simply still too high for the Reserve Bank to take any risks. We saw back in 2014-15, the Reserve Bank tightened monetary policy by 1%. They raised the official cash rate in expectation of inflation going up. It's what their economic model said. And they were wrong, and they had to cut interest rates very quickly, 2015-16. Well, now we see an expectation of inflation falling away, but the Reserve Bank doesn't want to make the same mistake the other way around. So we're going to continue to get this downward pressure on the pace of growth in the economy, the household sector in particular, over the next 12 months or so. So the outlook for retailing is certainly not good. Retailing, hospitality, and also residential construction, where we have the downward pressure from the relatively high interest rates. We have many people who are just wary of getting something built for the moment because of some of the stories out there about people losing money. And we have, as I've been warning from 2.5 years back now, a weeding out process in the residential construction sector, with simply too many inexperienced, undercapitalised, over-optimistic people moving into the sector from that boom which started with Christchurch and Auckland construction from about 2012, 2013. We've got the high cost of living, obviously just high inflation, depressing people's budgets out there, constraining spending. People are spending more, Kiwis travelling overseas. We've already done a big binge on motor vehicles, electric bikes and spas, gazebos, etc. during the pandemic. So there was always going to be this natural decline in economic activity now anyway. The IRD are catching up on stuff they've just let go during the pandemic. Same thing in Australia, where I am at the moment, with their Inland Revenue Department also catching up on a few things there. Overall, the negatives are dominating in New Zealand for the next 12 months or so over the positives. So this is why no recession. Good recovery in visitor numbers coming to New Zealand, with the Chinese market yet to really chime in. Maybe that's a story for 12 months down the track, an extra boost in tourism receipts. The foreign education sector coming up again as well, again with extra numbers of Chinese yet to show up, and New Zealand not yet enjoying the big boom in Indian student numbers, which is just overwhelming the main said cities across here in Australia. A big boost to New Zealand's economy from net migration flows, a record gain of 2.3% population boost in the 12 months to September. Not a single one of us were expecting anything remotely approaching that sort of number there. And while we have probably past the peak, or we're very close to it, the numbers will ease off. Going by what's been talked about across here in Australia with similar record net inflows, we're still going to be looking at a good number of people coming into the economy over the coming year, and that's just going to also keep the Reserve Bank nervous. They seem to, for the moment, have fallen on the side of, we think there's extra inflation coming along from housing pressures, rent, bit of extra spending growth. Yes, they seem to, for the moment, be downplaying the restraining impact on wages growth. More people sloshing around. The labour market is easing up quite rapidly in New Zealand. There will be a slowdown in the pace of wages growth. We just don't have the data there to prove it. And I think the Reserve Bank are going to wait until they actually see those numbers before they really do start easing off out there. There's obviously extra infrastructure. This is going to be a huge challenge for councils, for governments. There's about a century's worth, I guess, of infrastructure catch-up to be undertaken, and that's just going to keep so many people very, very busy for a long period of time. And the issue is going to be, where is the financing going to come from for that? The government's looking at changes in that regard, and also the availability of labour, which thankfully for the moment is getting slightly better. And also just note that house prices are now rising on average about 0.8% a month in the past 4 to 5 months, and I expect that will continue as we run through 2024, and that will also be assistance to the economy. Looking at, I guess, some of the impact overall from the new government, business confidence has increased quite substantially, but be careful about this one. On average, for the past 3 decades, the ANZ's monthly business outlook survey has shown actually exactly a net 0% of businesses confident about the economy improving or getting worse. Now, 3 to 4 months ago, we were about 0% pre-election. Now we're at plus 30%. The outlook for the economy has not radically changed as a result of the change in government, but business sentiment has bumped up by sort of 20 to 30 points. That is not an accurate reflection of the outlook for the economy. And when we look at what businesses are saying they're doing with regard to spending, we've only got a net 5% of businesses saying they're going to increase capital spending in the coming year. It's a wee bit better from 2 to 3 months ago, but the average there is 11%. So we are still looking at a weak outlook, I would suggest, for overall business investment, capital spending on the plant and equipment in particular is how we tend to think about that, but also some of the more efficient buildings, software systems, etc. Employment intentions, they're also positive, net 5%. This is good. The average is about 7%. So, the labour market, it is easing off, but not to any great degree in terms of pushing the unemployment rate up. Do not expect the unemployment rate to go to the 6.7% we reached in 2012. Well, after the GFC, the dynamic out there is quite different this time around. Maybe we'll get slightly above 5% within a year, but I think that's about as high as we're going to get there. The government have said they're going to be looking at a whole range of measures there, which frankly I struggle to figure out exactly, with regard to accelerating the processing of project applications and getting things actually happening in the ground, making the issuing of housing consents a smoother process out there. How exactly that happens in practice, given that we've heard this sort of thing before, is frankly, I'd suggest anyone's guess. I do believe things will be smoother down the track, but it's unclear what the time frame will be and exactly what the magnitude of the impact will be, and especially in the context of not just the processing times being a constraint on activity there, but for the moment it's the lack of orders coming through for the new houses and deficiency of bank financing for some of the multi-unit stuff as well. So helpful in terms of what the government, I'd suggest, is looking at doing and trying to improve the Resource Management Act and consent processing, etc. But I don't really think it's going to be radically changing the outlook for the housing sector or commercial construction projects generally. For housing, my view is falling construction next year, but naturally rising again in 2025. Just too much demand. It'll start going back up again. On the labour market side, this is what we get. We have Labor for a while, and they put legislation in favour of the unions, of the employees, and then we go back to National and it flip-flops back the other way. This flip-flopping used to be between the Employment Relations Act, the Employment Contracts Act. Now it's something like the 90-day free trial period, which will now be extended to all businesses, and of course the canning pretty quickly of the fair pay agreements also. There wasn't much of an impact coming through from that anyway. In theory, yes, it's going to make the labour market function more efficiently, but quite frankly, the bigger constraint out there for businesses wasn't really the legislation. It's been simply the availability of skilled, unskilled people anyway. On the migration side, I remember people saying to me ahead of the election, or even once we'd seen confirmation it would be National New Zealand First Act, that the migration outlook was going to radically change. New Zealand First would see to it that there'd be some drastic cutbacks. Well, they didn't go into this election campaigning on that, and there is no evidence of any attempts, in fact, to rein in migration flows coming through in the coalition agreements. If anything, we're looking at making it easier for some people to come in, with medium wage requirements being expected to be loosened, elderly parents able to come in with health insurance, that sort of thing. So no, I am not of the view the new government is going to lead to a tightening up on the migration criteria, leading to any particular radical slowing of population growth or extra difficulties for businesses getting staff, especially as explicitly in the via Act we have plans to increase the number of seasonal employees in the farming sector, for instance. Tax cuts middle of next year. Yep, helpful, I think, in terms of the overall economy. But from my view as a macroeconomist, I'm still looking at an overall tightening of fiscal policy. So some help for household budgets, some help for a recovery in retail spending for 2025, but I would suggest not really for 2024. Roads, so we're going to get some more roads, but if you're in the business, you'll know this takes a long time to design and other things and get them put in place there. So it's not something jumping out and saying to me, right, we're going to have radical extra road construction in the next 12 to 18 months in New Zealand. But hopefully these sort of things can lead to retention of resources in New Zealand for a better flow of these sort of infrastructure projects. Oil and gas exploration. I guess if I was running an oil and gas exploring firm, I'd be thinking, what are the chances that we'll see this legislation canned again when eventually we get a Labor-dominated government? And frankly, that might make me hesitant of committing, a great amount of money to exploring for oil and gas off the coast of Taranaki, etc. So I'm a bit unsure on that one in terms of really having much of an impact in the world that we're living in these days. And I just wanted to note, reducing scope of the CCCFA, the Credit Contracts and Consumer Finance Act, the changes to this from December 1st of 2021, contributing to a big credit crunch in the housing sector at the time. They're going to ease up on this, but again, it's unspecified how much of a stepping back there will be and how confident the banks, the lenders will feel about the stepping back on the CCCFA to make them step forward. At the moment, the banks are showing no inclination to compete against each other for market share, and I'd say they've been left in no doubt by the Reserve Bank that the Reserve Bank does not want them competing aggressively for market share at the moment and discounting their interest rates. It is notable that no other bank has followed Westpac when they made some small decreases in their fixed mortgage rates 1.5 to 2 weeks ago after a bit of a rally in United States interest rates and some downward pressure on the rates here in New Zealand. I tried to have a look through all the other various points in the 100-day plan, etc., but I simply couldn't pin down any great things in terms of magnitude of impact and when it would likely come through from these changes. This is more of trying to set up the more fertile, I guess, ground for the New Zealand economy to grow in a less hindered fashion over the medium to long term. But stuff like that doesn't have an immediate payoff. Just as with the Rogernomics, the Ruthernomics period in New Zealand from 1984 through to 1992, one doesn't see a payoff to any great degree in productivity growth in the short term as a result of those sort of reforms. And what we're looking at here, of course, is massively less than the strong changes there were back then. And as a number of commentators have noted, a lot of what we're looking at here is actually just an unwinding of what Labor have done over the past six years. And in some regards, as I've already said, for the oil and gas sector, one has to think from a long-term strategic point of view, when National are voted out again, which of these things will actually go back in the other direction. So look, I'm sorry I can't sort of sit here and say, as a result of the election of the new government, we are going to see a definite change in the outlook for interest rates, pace of growth in business investment, productivity. These changes will occur, but they're going to take some time to come through, and they will be lost in the wash of all the many uncertain other factors we have out there, such as what's happening with the Chinese economy. I mean, it's far more important than any changes, frankly, that the new government is making, and obviously events over in terms of Ukraine, Middle East, and global inflation more generally. So, Jenny, I'll just knock it on the head there and open it all up to questions and comments and see how maybe we can try and finesse it all down to something a bit more solid there for people.
That's great. Thank you so much, Tony. To all of our listeners, if you do have any questions, can you please pop them in the Slido box and we'll get Tony to answer those. There is one here for you, Tony. It's, why is the Reserve Bank so brutal with its measures to control inflation?
Okay, yeah, the job of the Reserve Bank is try and keep inflation between 1% to 3% on average over the business cycle, wording to that effect. And when you've got inflation, which was 7.3% just over a year ago, they've failed abysmally. The Reserve Bank failed, like central banks overseas, in leaving monetary policy way too loose. Not in 2020, but in 2021 into 2022. So they have catch up to do in terms of credibility, and I think their credibility as tighteners is now re-established, but monetary policy has quite a long lagged effect. It doesn't have an immediate impact on inflation. And inflation at the moment in New Zealand is still 5.6%. Australia's 4.9%, surprisingly low. They're getting, there it seems reasonably rapidly. In the US, the underlying measures are about 3.5%. Europe has just had lower than expected inflation outcomes. And to be honest, the view I'm running with is the Reserve Bank is still going to be staunch like this for quite a bit longer. I think they might make one or two friendly comments in late February, the next cash rate review. I think they will have some evidence of wages growth slowing down, but my sort of unspoken, unwritten scenario is the easing of monetary policy late 24 through 2025 will be more rapid than people are generally willing to assume at the moment. I think the Reserve Bank are deliberately keeping things tighter than may be necessary, simply because 5.6%, there's no scope for getting it wrong. But I think there's quite a rapid easing up coming down the track. So it's their job, and they didn't do it properly in 21, 22. So here's the flip side of it, unfortunately.
Great, thank you, Tony. I have a couple of other questions here. You mentioned that the government is looking at funding options for infrastructure projects, foreign investment being one of them. Do you have any further insight into these discussions? And also, are KiwiSaver providers in the mix? And if so, would this be a good investment for them?
Okay, don't know. I certainly have no inside information in terms of, further PPP projects. The experience there has been somewhat variable, I guess, shall we say. So no, I don't have any inside information there. When it comes to managed funds, KiwiSaver, I think the government will be very wary of trying to initiate any sort of formal relationship there, because too often people will look at the amount of money being built up there. I think we're $103 billion or so invested in KiwiSaver, and somehow get the view that this is money that can be made available for infrastructure projects out there, without thinking about, but okay, when these people retire and want their money back again, what does that mean? Explicitly selling off these projects into the private sector or whatever down the track? I don't know. So look, I have no extra information coming through in that regard. I think if the government is looking for extra funding, then they're probably going to have to be a bit more open to the foreign investment coming into New Zealand. I don't think that means they're going to be signing up to China's Belt and Road Initiative or anything like that, so don't start going down that route. But I think they will have to be looking at some more generous regime with bringing the money in from foreigners, because domestically, I perceive the funding isn't necessarily as readily available as one would necessarily like.
Okay, great. Thank you, Tony. Another question that's come through. Do you think next year's tax cuts will be inflationary?
Tax cuts are inflationary. They add a boost to the economy. The question is, what's happening on the other side? And my view is, on the other side, government spending, there's going to be a greater cutback that's occurring there. So yes, families, people, individuals through the tax cuts will have a bit of extra money, but will people really go out and spend it? I think not so much. With interest rates being relatively high, people will probably accelerate repayment of principal, etc. So I don't think the actual inflation boost will be all that much, and I think there's an offset by spending. So overall, I expect the stance of fiscal policy to be contractionary. That's including stimulus from the tax cuts, but cutbacks in other areas.
Great, thank you, Tony. I just have two other questions here. Is increase of migration inflationary, increased demand on services, products, or deflationary?
Migration, inflationary, deflation, the jury is still out on this one around the world, because often it's what time frame are you looking at? For the moment, I think we're getting extra inflationary pressure because of upward pressure on rents. People have to live somewhere, and I can see through my monthly survey of property investors a fairly strong turnaround on the ease with which they can find good tenants over the past year. That's radically turned in their favour. I can see extra upward pressure appearing on the rents, but also with costs going up, that's something extra coming through as well. So you get extra inflation there, which tends to occupy the minds of people, especially in Australia, for instance, at the moment. But in New Zealand, the big constraint on our ability to grow recently, and frankly ever since about 2005, has been deficiency of labour. And if we are to achieve the sort of economic growth goals people are wanting, we're simply going to have a good number of people coming in from overseas, especially as I perceive we are in now a structural lift in the number of young people going overseas for the opportunities, especially presented by strong growth, strong labour demand, good cost of living, high incomes available in Australia. The government's going to have a robust open-ish policy on the other side. So I'm not convinced it's inflationary in the long term because of the extra labour force which is supplied. But in the very short term, I can understand why the Reserve Bank is actually sort of ignoring the disinflationary wages impact and choosing to focus instead on the extra inflation on the housing side. They mentioned that 3 or 4 times in their monetary policy statement while downplaying the wages thing until they actually see solid, slower wages growth.
Great, thank you. And one last question for you, Tony. If China's economy continues to decline, what kind of impact will it have on New Zealand?
Yeah, it'll be a negative impact on New Zealand. Over 30% of our export receipts come from China. Predominantly, we ship minimally processed commodities over there. So this would be weakness in the farming sector. And on my list of negatives early on, I didn't even mention El Nino, as you know, the farmers have already closed their wallets about 4 months ago before El Nino came along. So there's extra constraint in the regions for the next 12 months in New Zealand. But yes, if China weakens, this is of major importance to us. If China sneezes, we get a cold. And we can already see the impact there in the demand for the forestry products related to construction. And Chinese households have over 80% of their household wealth is in property. They have either seen property prices go down, or what they signed up for as an investment, it's simply not there. It's not being built, and the money has simply been lost. Chinese families are looking to rebuild their wealth through higher savings. And that means decreased spending, and that means less going out to restaurants and buying the products from New Zealand, the food items that go into the food services sector, dairy products, fruit, red meat, etc. So this is important for New Zealand. And that's why I say what happens in China, quite frankly, is going to have a bigger impact on New Zealand's pace of growth in the next 3 years than the government policy changes.
Great, thank you. And one final question. Somebody has asked, Should we fix or float mortgages for the next few years?
Yeah, see, this is what the article I just wrote this morning. I've had to tone back my language from the first way around. I get so peed off with us Kiwis. We're so stupid, basically. Some people say, well, why don't banks offer, 10, 20, 30-year fixed mortgage rates? Because we Kiwis don't touch them with a barge pole. We, at the moment, are fixing for 1 or 2 years, and we're trying to tell ourselves, I'm clever. This is a strategy. I'm fixing 1 or 2 years, even though it's more expensive than fixing longer, because the rates are going to go down. This bloke just said he thinks they could go down quite a lot in 12, 15, 18 months time. And then when rates are low, I'm going to fix long term. So this is what we say to ourselves at the moment. So we think, maybe we're trying to offset the pain from paying, 7.3% or whatever. And then in 2 or 3 years' time, when the long rates are much lower than they are now, we will not fix longer term. We will go, but why would I fix long term when that's going to cost me more than staying on fixing 1 to 2 years? And so we will stay fixing for 1 to 2 years. A few people will go to 3 years. Hardly anybody will fix for 5 years. And then the next time the Reserve Bank raises interest rates again, we will do exactly what we've been doing the past 2 years. We will bitch and moan about the Reserve Bank. We will come up with unworkable ideas for alternatives to interest rates to fight inflation. Whereas we could, every single one of us, step outside that whole debate by simply, when the interest rates next get low-ish, we fix for 3, 4, 5 years, if not longer, if somebody offers it. And so let me just finish by saying, if you had listened to what I was saying in the second half of 2020 and the first half of 2021 and fixed 5 years at 2.99% rather than taking the candy of fixing 1 to 2 years at 2.29%, you wouldn't be given a stuff about the Reserve Bank or anything at the moment, because you'd be fixed through to the end of 25, if not into 2026. So I'm quite critical. My comments here are quite strong. Hey, I make a living out of talking about this sort of thing, but for the moment, people are going, I'm going to fix short and then I'll fix long. And when time comes to fix long, they're not going to fix long. They'll stay rolling 1 to 2 years. If I were borrowing at the moment, I would be looking at 12 to 18 months fixing, but I would be planning then to fix 3 to 5 years when we're at the bottom of the cycle. Best guess, maybe 2 to 3 years from now. Other people, they won't.
All right. Well, thank you very, very much, Tony. To all of the people online, if there are any other questions that sort of pop into your head that you'd like an answer to, please email them to me, jenny@surveyspatialnz.org, and I will forward those on to Tony for you, and we'll get a response for you. So thank you, everybody, for listening to us today, and thanks to you again, Tony. Have a great day, everyone.
Thanks, Jenny. Thanks, everyone.